Good morning, folks. How are you? Happy Friday the 13th. All right, so it's going to be a short one today. I usually make fun of the folks that don't know how we do things around here by teasing like that, and then I go for a very long time. I do not have that today. Good morning, folks. How are you? Listen, this guy butting in all the time. Listen here, buddy. Nobody asked you for your 2 cents. So the idea of staying with you the whole session, I don't have the luxury to do that, but I promise I'll be doing some of that next week. So we'll be live candlesticks during the entire morning session. I'll have to divide it in probably 2 sessions to make sure that the translation stuff that YouTube affords those individuals that want to hear me talk in other languages um, by means of AI, you'll have that. So anyway, I owed you, not really that, I didn't really owe you, but I said I would do a review commentary last night, but I raised my niece and she came to me with a need and for counseling. So that took up the rest of my evening. So I apologize and I appreciate your patience in regards to that. So I'm going to go through, let's actually start with the dollar index. I'm going to breeze right through a lot of this stuff, okay? I mentioned yesterday on X, it's Piper, so trapping around. I asked everybody on X what this PD array was at the low, and this is an immediate rebalance. And usually when you see that, it's a very, very strong bullish scenario. And you can see that little tiny inefficiency there. There's a minor buy side there, and then we have the other buy side. I told you that I kind of like myself right here. And that translates to obviously bearishness on euro dollar. And if you recall, I tweeted the sell side I liked, and we got that this morning here. So you can go look at Twitter, go scrub back, and you'll see this was the level we were looking at. And that's enough. Okay. So now you want to break that run down and study what PD arrays afforded a setup that was a short. This was the only location I was interested in. So it wasn't like a back and forth two-sided expression of interest. It was just simply looking for this and a higher dollar. Cable, pound dollar. I mentioned that I'd like to see this buy side of balance, sell side efficiency turn into a bearish inversion fair value gap. So what it has here, we've already traded down to it there. We had a little bit of discount sensitivity, and now we're right inside of consequent encroachment. So I'd like to see it trade down, get below the lows over here, and then stay out of the upper half once it leaves the low, and then make an attempt to try to get down here and get the sell side here. And best case scenario, shoots for this low. If you look at it, it kind of looks like a market maker sell model, right? So that's how I'm interpreting it. That's what I was looking for. And so far it's starting to pan out a little bit, but euro was obviously the heavier or the sick sister between the two. Crude oil, just real quick. All right, so there's the business. We were looking for higher prices. I still think that overall in the coming weeks and whatnot, um, the short term little give back here, I think it's a catalyst to a lot of nations coming forward and providing stocks and supply of crude oil from their reserves. So that kind of always dampers or dampens rather, the the supply and demand effects of real commodities that exists in things like this. There's a real supply and demand factor in commodities because they're real um, markets. They're very influenced by real supply and demand factors, whereas like stocks or currencies, you know, cryptos, futures, just there isn't any real reason to own that stuff. But crude oil, we need it, right? Wheat, we need it. So I suspect that over the coming weeks, and especially probably over this weekend, we'll probably see some intensification of things. And statewide, here in the States, I tweeted something that most of you folks outside the states really probably wouldn't get what I mean by what I'm saying. So I'm just going to blatantly say it right here. Um, the things I told you about, false flags, um, quote unquote terrorist attacks. Um, if you can, if you can afford it, if it's legal where you're able to do so, and it's something within your means, then you should go out of your house armed with lots of ammunition that will help you if you end up in a potluck, like we've seen just in the last few days. And that's what I meant. To just keep your head on a swivel, be diligent, and over in the UK, I would expect things to probably get a little wild over there as well. But you guys don't have the Second Amendment like we do, so that unfortunately is that's a that's a that's an unfortunate thing. But there's lots of things you can do. I think people are going to start getting really unruly, and that's going to creep into the market. Okay, that sentiment, that uncertainty, that fear. I'm not sowing fear. I'm not saying to be afraid. I'm not afraid of anything. But investors and the sentiment around investing is going to be influenced by all this stuff. Okay, but crude oil is absolutely not out of the water. Um, I think we'll be over 130 here, rather soon, and I don't think that you should be trying to participate in it because the volatility may be very difficult to stomach in weather. So again, just keep that in mind. Energy prices, don't go out there and spend money on dumb stuff. Start putting some money aside for your utility bills and energy bills because it's going to be an impact on your finances. All right. So what was the other one I want to look at? We'll look at ES real quick. We're going to look at through the micro. Okay. So MESH2026. Right? And I have some artifacts that are not properly annotated, showing only on the lower time frame. So just disregard that, okay? I'm not hiding anything. I'm just saying that it's not worth bringing it into the conversation here. So we had the daily chart on ES, which has been part of this rather long, drawn out trading range. We finally got below rejection block here. This is your next pool of liquidity. That's where my focus is on ES. Okay. So over the coming days and weeks, my focus is still staying with being short. I want to be short. I don't want to be long. I don't want to be buying because there's no reason to be buying. There's absolutely no reason to be assuming risk to the upside on stocks. Nobody else is doing it. And I think really um, we're probably going to have a wild and volatile summer. Whereas usually summer months are just real lethargic and not really prone to give too much of a sustained one direction run. I think we'll start seeing a lot of that. And the volatility will be large enough to trade, but hopefully not so wild that it's not conducive for trading at all. And I'll comment as we get closer to those late spring, early summer months. But we are getting into the time of the year where I love, which is springtime. Springtime is a wonderful time to be trading because the daily ranges become a lot more fluid. The intraday deliveries are just so much nicer and cleaner. And you're going to see a stark contrast between what we've seen in January and February and majority of March. It'll start loosening up. Regardless of all the geopolitical stuff, it still will loosen up because of the seasonal impacts that come in. Companies still have to do business. They still have to do commerce. They still have to buy and sell all these things that make their little cogs in their big machine, their corporate machine. They have to do these things, regardless of what's going on in the Middle East, regardless of who's in the White House, and it doesn't matter. All those things are still going to be pertinent to pushing through the financial machine and what it does on a year by year basis. So lower prices on ES, that's where I'm looking right here. So that's your price that you want to have on your charts. And this would be seen also real quick because we're getting close to rollover. March contract will expire. So I want you to see it from June contract. So right now we're looking at the March contract and that symbol code for month. March is H. The next contract we roll over into indices is June, and its symbol is M as in mentor. So we're going to take a look at that. That's the low here. So this is the low you would have on your June contract. It's slightly a little bit lower here. That's too shallow for my liking. So and again, I'm expecting that to give up the ghost and be traded a lot lower than that. And you can't really see anything over here because it's spotty and it's useless over here. So we go back to MES H2026 and it gives us more information. And there's those relative equal lows that I told you about that I like a little bit longer term. So by mid-June, first week of June, I'd like to see these be traded to, and as much as this right in here. So 4th July, before my birthday in August, um, I think that that's a reasonable downside objective. And then it gets interesting after that. We don't want to forecast anything much more beyond that because you know there's so many other things going on. All right, so now we can run over into micro Nasdaq. Why are you doing the micro, bro? I'm trying to promote the sober mindedness that is vacant in the majority of everyone teaching today. Everybody wants to be the heaviest hand in their trade. Everybody wants to be trading the largest size. They want to be able to show everybody, how much drawdown they can absorb before they get their small little payouts. I'm trying to be Mr. Rogers and remind you that the volatility is nuts. And if you don't know what you're doing, you're not experienced that well in terms of following a model, even having a model, um, where you don't have any discipline. Chances are you probably don't have a whole lot of money. So why would you be trading with big leverage? So you can't get anything less than a micro contract. And that's our focus this year. I want to kind of teach if you ever decide that you want to go into this with real funds or go into a funded account setting, you make that decision. I don't ever say, now it's time for you to do that. But should you do it, I'm trying to showcase examples on how looking for small little base hits and allow for a little bit beyond that. And as your experience grows and your skill set improves, that experience will translate into significantly larger price runs that you can participate in. And you grow into leverage. You don't rush through it. You don't say, well, I'll start with one micro, Michael. And then if I make a couple wins, 2 or 3 wins is enough for me. I know enough now I'm going to start trading the mini, and I'll do 5 or 6 minis. You won't be able to stomach the fluctuations, even in your demo account, prop account stuff, because those numbers mean something to you, and you haven't properly graduated in seeing that tug of war, that emotional stimuli, the chemical imbalance, that chemical romance of shifting from fear, uncertainty, greed to indifference. I'm just following the model. Those numbers mean absolutely nothing to me because I'm watching what the price is doing. And as long as price is doing what it should be doing with the PD arrays and order flows on side that you're trading on, hey, that's all that matters. You're sticking to a process. You're sticking to a model. And 99.9% of educators don't teach properly. They want to rush you into trying to get money because if you get a win, even without a lot of experience, it tricks you into thinking they gave you something. They gave you the Holy Grail. So what does that make them? That makes them kings online. That makes them goats, okay? Or the teacher that everybody wants to learn from. I don't teach like that. I tell you, slow down, start small, and graduate over time with that. Every single time someone goes out there and tries to shortcut it, they always blow up. Give it enough time, they will blow up. Some people have a little bit longer streak of doing things that just happen that, they're on the right side. But you can't attribute that as skill, but they will call it skill, and it's not skill. It's just happenstance. I had 9 months of that when I first started, and I found out that it isn't like that. You have to really learn who you are and how you're going to engage with price action. All right, so right away, down in here, that's my target intermediate term. Okay, so that's where I think that Nasdaq will eventually gravitate to. I want to see that eventually by summer. You know, certainly before my birthday. Okay, but I think probably June, if we get something crazy happen, like say for instance they drop a tactical nuke, which I honestly believe it's coming. I believe it's coming, and we're going to see that, and that's going to cause all kinds of reverberations across the world, across the markets, because that's what they want. They need the they need the boogeyman. They need the scare factor, and don't be afraid. There's nothing you can do to stop it. Don't worry about putting any sunblock on. You won't feel it. It'll just you're there and you're gone. So live your life, seize the day, carpe diem, and let's focus on learning how to trade and improve, and hopefully make our ends meet better. Daily ES, we already went through this. Make sure I'm plugging my laptop. There we go. I would have been powered down during the live stream. That would have been somewhat embarrassing. The uh, the low here was taken a little bit more pronounced than that of what we saw in ES. And then we had a little bit of retracement. And now we're back inside this consolidation. Now, this is what I want you to observe. While we were up here, I mentioned on a Trader Roundup podcast, which usually follows after I do a live stream, and I won't be able to be a part of that today. So don't be upset. But if you're going to have it, Kit, and everybody that usually joins it, I'll look at it late tonight before I go to bed. Once my family goes to sleep, I won't have the luxury of sitting in live to hear it. So that tells you, I mean, what I meant at the beginning of this. I can't be here long. So I mentioned that this is probably where they're going to take it if it kept going, and then they dropped it pretty aggressively down here. So what I'm looking at, and this is what you should be focusing on as well. If you look at this low to that high, this is a range of price action, and don't look at the color as any real significance here. All I'm trying to do is highlight that range. So inside this range here, we've already explored on the outside. Now, midpoint or equilibrium is right here. As long as we remain below that on a body basis, in other words, if the bodies stay below that, everything remains bearish. If we get back above and we have a close today above this midpoint here or equilibrium, this level becomes a factor. Okay, so this here's my opinion. If they want to be rude, they can come up, clear those relative equal highs out, and immediately smash it down and go running aggressively lower. I'd prefer it doesn't do that. I'd prefer they don't even come up here. They stay below equilibrium, which is this line right in here. As long as the daily candlestick bodies stay below that. Next point of business is this low here. And then this low, but this consequent encroachment on that wick, you're gonna have to note that as well. And then ultimately down here, okay? So with that, we're gonna take a look at, and here's an artifact I didn't have properly annotated. It should have been only showing on the 1 minute chart, but we'll see it when we drop down in. Okay, 1 minute chart. Scrunch this up a little bit. I'll show you what these white areas are in a moment. All right, so we had a nice sell-off. And what these white areas are, they are the regular trading hours opening range gaps for the respective days that begins that shaded area. And this one here goes back to Monday. So here's Monday, regular trading hours opening range gap. And then I graded it. And then you can see, well, let's look at it this way, regular trading hours. That way you can see what it is I've annotated here. So I'm reviewing, I'm not looking at live price action. If you're going to be trading, just turn my live stream off and go do your own business and then come back and watch this stream later on today. I'm not going to call anything live while we're here, just to put it that way. the opening price down here on Monday, and then where we settled on previous Friday. So there's your regular trading hours, opening range gap, new week opening gap, both blending. And then you can see the levels being utilized here. The body staying above consequent encroachment, body staying right there on the octant level. Again, here on the upper quadrant, upper octant. And let's take it over to real time right now. Premium gap. Watch these levels for any retracement. This is Monday's regular trading hours opening range gap. Okay. But yesterday, did a lot of talking the day before, so I wanted to just walk the walk. And so here we have Wednesday's regular trading hours opening range gap and previous settlement time at 4:14. This makes Thursday's regular trading hours opening range gap. And then first percent to fair value gap is in here. This portion of price action, we're in this range, opening range gap, regular trading hours opening range gap. And when we go into electronic trading hours, you're going to see what was pertinent, why I was shorting all right here. I did not anticipate the, what is this, the consequent encroachment of this gap because of something I'm going to show you when we get into electronic trading hours, okay? So I got a lot of questions sent to me in the comment section of the YouTube, and some of them were sent to me on X. You know, how did I know? Why did I trust that it wasn't going to try to go up into this gap more and not even go back up to consequent encroachment? Okay, I'm going to teach that to you. But notice that we're inside here. We have the lower octant, lower quadrant. See that? Where are the bodies hovering? Below that quadrant. So this is going to be much more understandable when we go into electronic trading hours. So let's go into electronic trading hours. And then be careful because sometimes this thing acts stupid and then I lose everything. All right. So now here's that regular trading hours, opening range gap, and the consequent encroachment of it. So at 9 o'clock in the morning, we ran up. What did we do? We took out these relative equal highs. So what's rest? Well, it's buy side. So if we take that out, and this forms a buy side liquidity pool raid, it's occurring on a octant level of the opening range gap, regular trading hours opening range gap. That's that white shaded area, and each one of these levels are your gradient levels, the quadrants and the octant levels. This is what I taught you this week. You want to find a purge on liquidity above relative equal highs or a single high. It's not just simply only relative equal highs, it's a single high too. Anything that runs liquidity and then starts to go the other direction, or if you suspect that's what's likely to pan out. Let me see here, make the candlesticks a little bit more prominent so it's easier for you guys to see. I know, I'm such a nice guy. Not even charging extra for it. Good old ICT. So we had this short-term little buy side liquidity pool. It runs up into it, okay? So when we have that, what we're looking for is a PD array that gives us a point of reference. So right before that liquidity is taken, if we can compare and contrast with other nested PD arrays, what do you see here? There's a small, look at the close on that candlestick. You're looking right here, right there. Okay, that price. What's the close on that candlestick right there? 24,828 half, okay, or 0.50. The open on this candlestick is 24,828.75. So it's 1/4 of a handle higher. That's a volume imbalance. So you have to include that. I saw a post yesterday. Someone was saying, "Can you tell us what the deal is with volume imbalances because it keeps changing?" No, it's not changing. Nothing's changing about it. You're getting more detail. Okay, and then this candlestick's low, 24,834 quarter. That is a SIBI. I'm sorry, it's a BISI, buy side imbalance, sell side efficiency. If it would have had a volume imbalance on the high end, that's a suspension block. It's not a suspension block. They're all treated the same way. Difference is when there's a inefficiency that has a volume imbalance in one side or both, you have to note it, or you won't have your correct levels. What is this candlestick right here? What's that? It's an order block. This candlestick right here is part of this overall run to this liquidity, that opening price. See anything there? What do you see? Runs to liquidity, order block. If this wasn't a run just to get here, dropping back down there, that would have been used to go long. This would have been a bullish fair value gap. But because we're part of an opinion I'm sharing as a hive mentality that I'm bearish. So watch me engage price action with what I've already told everybody. I'm not looking to go long. I want to focus on the setups that are going to present selling opportunities where the market will yield lower prices. I'm looking for those. It doesn't mean that it won't be an opportunity for me once in a while to get in here and do a intraday long, but I'm primarily giving you examples of just looking for the shorts because it's me sticking to a narrative. It's me sticking to a bias, what I believe is the underlying pinnings of the market right now, and sticking to that and not deviating and changing my mind all the time, which is what many of you are doing because of your infancy as a technical analyst. You're changing your mind a lot because you're being influenced by short-term price fluctuations, or you're being influenced by other people doing other things. Okay. And that's the problem when you watch other people do things with their money. You can't spend their money. You don't sleep with the losses when they take them. So why are you worried about what other people are making or losing? You're worried about all the wrong things. This is not a sport. It's not a spectator sport. You're here to learn how to do this and by yourself. If you plan on going out and showing the world everything, your financial statements, your tax records, everything you're doing, go for it. Go for it. But anybody that has any common sense is going to be like, none of that stuff's any of your business or anyone else's business. And it doesn't make you more money by you showing everybody else how much money you make. What happens is you end up losing more because you start putting this report card theory to test. And as soon as you tell somebody what you've made, they're going to want to come back to you later on and say, hey, how you doing now? And it better be more than what you did last time, or we're going to make you feel bad and embarrassed. So it's the worst case scenario for someone that's learning how to do this because you're building up all of this uncertainty and with little experience, and that becomes the paramount issue. Not am I improving and sticking to a model? So that was my little bit of a rant. But since it's a run just for liquidity, this order block can't, it cannot be part of a buying scenario. So what is it going to be? Mitigation block. Oh, we don't talk about that much. So this candlestick right here, it starts these two down close handle. This is the parent order block. Why? Because it's laying over top of an octane, or I'm sorry, the quadrant level, 0.25 of that white shaded area, which is the regular trading hours opening range gap. The orders that are significantly used to get you in and out of your demo trade. Remember, I'm now someone that's going to tell you get into live trades. I'm not licensed to do that. But when you're looking for those practice sessions, when you're trying to do demo entries, everything has to be anchored to these gradient levels. Otherwise, you're guessing. Once in a while, your order blocks, your fair value gaps might work for you. But the times that they work, until I started teaching it this year, you had no idea why that gap worked. But everybody on there on the internet has the secrets to picking the right fair value gap. Why your fair value gaps are losing. And everybody that has a video that has like that title, go and delete your video because you lied. You don't know what you're talking about. You're misrepresenting my work and you have no idea what you're talking about. This is what's validating it. Okay. It needs to be on top of a gradient level. Okay. This order block, where is it laying on top of? This gradient level. Here's a paradigm shift. Okay. Some of you are looking at this. So how can that be an order block? Because you said it has to be part and laying on top of a gradient level. Right. But look at the parent contingent relationship, the hierarchy. This is the parent order block. That candlestick is laying right on top of that. What is a propulsion block? A candlestick that trades down into the lower order block. This one need not be on a gradient level because its characteristic is borrowing the previous order block as discount sensitivity. This is perfectly traded down into that. I'm going somewhere in case you haven't picked up on what it is. I'm showing you what I did when I did what I did yesterday. There's your order block, change the state of delivery, that opening price. It opens up here and trades down right to it by a tick more below it, and then comes here. Next candlestick, we open, trade down into the order block again, and then rallies up. This is a valid propulsion block when it's bullish or buy side delivery going to buy side liquidity. This cannot go down to half of this range. It clearly didn't do that. The only thing it did was what? Use the opening on this candlestick right there, which is a change in the state of delivery. Long, long to get to buy side. This is a small little bread and butter scalp. It runs up to take that liquidity, but now watch. Borrow this fair value gap and then blend in the previous down close candle, which is an order block. It's a bullish propulsion block, but part of a run on this liquidity. So we anticipate this to be taken out on the downside. So we can borrow both of these ranges because they're nested. Two PD arrays with the proper context. Market structure is not the answer. That's not the secret. Okay. A lot of you 20-year-olds run around saying, uh, Michael doesn't teach market structure. Michael doesn't know market structure. I don't need to look at any relationship between intermediate term, short term, and higher time frame, long term highs to smoke all of you. All I got to do is read the candlesticks just like this. I don't need to have anything small, I mean, anything bigger than what I have on my chart right here. That's all the candlesticks that I would need. And I could buy and sell both sides. Market structure is not the answer. Knowing what the order flow is going to be doing, not with looking inside the candles and looking at how many contracts were bought and sold. Notice we're not doing any of that here. Okay. Everything is to open, high, low, and close, and it's time. It's time based. What time is this? Look at the bottom of the chart. It's 9 o'clock in the morning. What is that part of? What's it part of? Macro time. So it's running to get that liquidity during the macro time. The highest candlestick that runs that liquidity out is 4 minutes after 9. We drop down into this order block. If it was bullish, this would be enough to send it higher, but it's not bullish. We're looking for lower prices. Why? What's down here? Relative equal lows. Below relative equal lows, it's sell side liquidity. They took the buy side first. When it's bearish, this is exactly what you want to see. Buy side and then run for the sell side, then continue. Okay. Consolidation, fake bull flag. All we do is trade bull flags around here. We don't complicate everything. And then you're constipated. Runs right on through. And then we wait for price to do what? Here is the opening candle rate. Let me scrunch this up a little bit and widen it out. 9:30 candle right there. So we open there, which is why it's the low or the white bottom edge of that rectangle that's being shaded. That's why it's there. And then we trade all the way up to this same gap. Now, this gap would have been bullish if order flow was bullish and the narrative was bullish, but we're not. So this needs to become what? Inversion. So it becomes an inversion fair value gap, changing the state of delivery. It can trade there. And since it's going to trade there, it can trade just above the high of that inversion fair value gap. And that's why that one tick is afforded to do so, because it has to encapsulate a run that would be just above that opening price of that order block. That's now going to be a mitigation block. See what's happened there? It's changing its state. Just because you see a down close candle doesn't make it a bullish order block, and that's all there is to it. You guys got to delete your videos, man. You literally have no idea what the fuck you're talking about, and you're going to look stupid real soon. So you might as well just take them down quietly. I'm not going to troll you. I have a whole list of names, but all of yours, if you're talking about order blocks, you don't know what the fuck you're talking about. Okay, you have no idea what you're talking about. So because this is anchored to this order block that originated because it's the parent in order flow with the PD array, this one is connected to this. So this here need not be part of a gradient level because it's anchored to this order block. This is part of a run to buy side. They give you a retail pattern that's going to fail, a bull flag. Then it drops down aggressively, goes to the sell side, trades outside of the opening bell price at 930 there, trades below short-term low there, and then runs up. It pumps it up into this level. And I recorded myself trading it. It was perfectly done. Perfectly done. Using the logic I'm telling you here, because it is real order flow. It's real technical science. It's how the market's going to use these levels that are not hidden from you. They can't hide it from you. There's no reason to be fearful of it. And if you think it's complicated, it's only complicated because you want something easier. So just roll your sleeves and say, okay, this is going to be requiring a little bit more work than I thought, but I'm going to get it because you can. You can get this. So we have relative equal highs here. And during the recording, you can watch it on my X feed. It was posted yesterday. I highlighted, just like I'm doing right here. I'm saying without having to talk, you know what I'm saying, without having any audio, because the video just has a song that I absolutely love. And that buy side liquidity, they run above it, and I'm shorting it. And then as we get approaching into this PD array, premium array, I want to sell short. I want to keep adding to it. I'm using the wicks in here. Every time it gives me an opportunity to trade at the consequent encroachment, just close to it, I'm going to add one more. And I built a position of 4 micro contracts, and then you watch me manage that. These are the executions. It's going encroachment of that wick there. And it's on top of the upper quadrant. You see that? That blue line, watch the entry. Bang. Not random, not shotgun blast. And then talk about hopefully it looks like something cool later on. That's what all these yahoos out there do. They have no logic as to what they're doing. They're just guessing. Just like when Forex was real hot and it would show you like a whole page of 50 contracts or lots of trading gold, okay, or pound yen, and they're all like one tick or two away from each price. What is that? That somebody has no idea what they're doing. But people used to lick that stuff up and just love it. It's fake. It's all fraud. It's what it was. But anyway, the distribution from this area here trades down, and then I marked out where we had targets reaching for liquidity, and I ran the event horizon between two pools of liquidity. I'm going to leave them as they are in the video so that way you can do it yourself. But you can see that the liquidity was taken below here, and then the event horizon was right here, there. And then ultimately, look what it did. It traded lower, and then we created a run into Monday's regular trading hours opening range gap. This one over here was just simply me using a small little wick. I used the consequent encroachment of this. I was teaching my youngest. Why am I using this? Because this candlestick is laying on top of this key level. So it's wick when price is trading down into it right here. Did we close on that candlestick below the consequent encroachment midpoint? Let me take all the levels off except for that. See, here's your screenshot opportunity. I want to know what your fib settings are. This guy is so generous. Look at this. He's full of himself. Listen to him. Consequent encroachment of this wick. That candlestick closed below it right there. So now it's easy. All you got to do is look for the volume imbalance in here or at this price level, get short. See if I can show it there. It's not, my little thing here is hiding it. You can see the prices up here. There's your price right there. That makes it easier. Okay. So the level is 24,856.75. That's the midpoint or consequent encouragement. I'm selling above it as a premium to that price, part of that volume imbalance. Okay. Nothing random, folks. Surgical precision. Okay. That's what it is around here. And then ultimately just running for just the sell side liquidity right there. And you can see that happening there. Okay. So that's the business and what I was doing yesterday. And now let's just take a real quick look of something I said I was going to look at. Look how it used the Monday opening range gap quadrant and octant levels. Nice little reaction there. Completely random, right? Completely random. Runs up, trades down. We're using that level. That level. Look at this. Look at that. My goodness. Look at that. All the way down. Look at this right here. What's that? What's this low? 24,517 even. And that's one tick below the octant. Sell side, trading below sell side. Can it get to that next level, or in this case, gradient level, lower quadrant? No, it reversed. That's bullish. Okay, so the high of regular trading hours opening range gap from Monday's trading. So Friday into Monday, that's what we did earlier in the beginning of this live stream. And then ultimately sink lower and just trade outside of Monday's opening range gap. Back in, now we're back in sync. Look, lower octant, upper octant, that octant there, there, there. Look at all the work right here. And pumped up, back down in. Where's the bodies? Staying right there on that octant level, pumped up into Thursday's first presented fair value gap. Now, what happens if you just relax and you're not trying to trade every candlestick? What happens when you start looking at price at these levels at the time when price should start spooling? Macro times. What do you think happens? All the ambiguity, all the uncertainty, all the fear, all the things that you're worrying about, these missed moves. I'm afraid I'm going to miss this move. Why? What are you afraid of? What you're fearing is the result of you executing on ignorance. That's what you're doing. You're afraid of the pain you're going to inflict on yourself because you don't know what you're doing. You're doing that. You're not afraid of your model not working because you don't have a model. You're not afraid of your process and protocols failing because you don't have any. You're guessing. You're chasing price. That's all you're doing. And when you show me your executions, many times that's what's proving it to me. And the ones that talk about how they took trades and they don't show their executions, I completely ignore entirely. So you have to be honest with yourself. Why do this if you're going to be lying? You want to do it the right way. You want to pursue this correctly. The right ways all the time, the best way. And it may feel like it's moving slower for you, but having these levels in price action and then coupling them with time, everything unlocks. The setups that you want to be a part of, you'll be able to see them coming beforehand. You'll anticipate them. You'll you'll not react to it. You're predicting them. Where's liquidity? Where's the inefficiency? Are we discount to premium or premium to discount? Where's that fit in the narrative of what price may be doing right now? And that, my friends, is going to be it for this morning. I have a wonderful weekend ahead of me. Lord willing, I will be back with you again on Saturday morning. I will give you a shotgun Saturday on X. Um, I don't quite know what I want to talk about. There's 3 topics. I might end up blending them all in. So pack a lunch. It might be a long one. Until I talk to you then, be safe.